Thank you for joining us today as we recap the results of the First Business Bank Business Statistic and Trends Report. First Business Bank has conducted this annual survey all the way back to 2004, and it's meant to provide insight that adds value to the business communities that we serve. This survey actually produces two sets of data. It gives us actual performance for the current year, so 2021, and projected performance and results for the upcoming year, 2022. There is a full written report available on our website that also details the results for each of the markets where we have a physical presence. So for Dane County, Madison area, for the Milwaukee and Southeast Wisconsin market, the Fox Valley and Northeast Wisconsin, and the Kansas City metro markets. For today's video, we're going to focus primarily on the results for the composite of our entire footprint. A little bit about the respondents to this year's survey. As always seems to be the case, we have a broad cross-section by type of business and also by size in terms of numbers of employees. When you look at the individual survey results, you'll see that they tend to be reflective of those markets. For example, Southeast Wisconsin and Northeast Wisconsin tend to have a much heavier concentration of manufacturing companies that responded to the survey. Survey generally is completed by a business owner or executive. I want to talk a little bit about the environment at the time the survey was completed. And thinking back to last year in 2020, we were really still in firm grips of the pandemic. We didn't yet have a vaccine to fight the pandemic. We were in the middle of a presidential election, so there was a lot of uncertainty at the time. We just had a historic downturn in economic activity in the second quarter of the year, and things were on the upturn. People were optimistic, but it was definitely an uncertain time. So this year, as our survey was completed in around the early September to the middle of October, kind of that 6-week period, we had two pretty good quarters. The first 2 quarters of the year pretty strong with year over year with annualized growth of 6.3% in the first quarter and 6.7% in the second quarter. Now we didn't know what the third quarter results were yet. We didn't get that number until after the survey closed, but we knew, all the signs kind of pointed to the economy pumping the air brakes a little bit. Things had slowed. We had Hurricane Ida in the quarter. We had ongoing supply chain issues, shortages, labor shortages, and those all combined to sort of limit the output of the economy. So we do know now that the growth, in fact, did slow in that third quarter to an annualized rate of 2.1%. Now, employment is another big issue that you see a lot in our survey, and attracting and retaining workers continues to be a major challenge for our business communities. Now, last year, if you think about where we were in the fall of last year, we had gained back about half of the 22 million jobs that were lost on the front end of the pandemic, this 22 million job loss in March and April. So last year, we were about halfway there. We've continued to add people all over the course of this last year so that by the end of October, we're about 4.2 million jobs short of where we were prior to the pandemic. Now, demand for employees is very, very strong. As of the end of September, nationally, there were 10.4 million job openings, and there are only 7.6 million people that are looking for work, that are among the unemployed, that are seeking work and would take a job if offered. So there's a mismatch there. There's a huge amount of demand. The national unemployment rate as of October is 4.6%. But we know that in our markets, unemployment is much tighter than that. In the Northeast and in Dane County, the unemployment rate as of September, only 2.6%. In the Kansas City metro market, it's 3.5%. And in Milwaukee, it's a little bit higher, 4.1%, but that's a little misleading because the rate varies widely depending on which county you're in that metro area. So our employers are in a very, very competitive environment to attract and retain employees. You'll see that for sure in the survey results. Now, another topic on the minds of not just businesses, but consumers as well, is inflation. And inflation is largely a function of supply and demand. And of course, supply was curtailed by the pandemic, the shuts down, the supply chain, Hurricane Ida in the third quarter, labor shortages, all of those combining to create shortages. At the same time, there's a tremendous amount of demand for goods and services. So there's that mismatch that drives prices higher. And at the time the survey was completed, we were kind of sitting in that mid 5% range, 5.3, 5.4% year over year inflation. Of course, since that time, in this latest month in October, the inflation rate popped a little higher to 6.2%, and that's the highest rate we've seen since 1990. So it's definitely on the minds of both businesses and consumers. When you look to the right side of the page, we see that 6.2% inflation rate, and I've just showed you some of the categories. Here's one culprit: energy up 30%. Gasoline's up 50% year over year. But really, it's a broad-based increase in a lot of these categories, so people are starting to feel it. And we'll see that in our survey of business community. Let's turn to the results and first look at how companies fared in 2021. And we can see that results are strong for both sales and profitability. And this is compared to results for last year. So about 70% of the companies in our survey had stronger sales in 2021. And that's a reversal of what we saw in 2020. So that line has reversed from the shutdowns and the disruptions that we saw in the earlier months of the pandemic. On the profitability side, not quite as strong, but 56% of the companies in our survey having stronger profits in 2021 as compared to last year. Now, respectively, 17% and 24% saw declines in results for this year. Looking at employee counts and wages, our companies in our survey did add employees, but I think intuitively that number could be a lot higher if there weren't so many challenges in adding to the headcount. Nonetheless, 44% of our companies have more employees this year than last, and only 17% had a reduction in headcount this year. As you might expect, in a competitive employment environment like this, wages are higher. 78% of our companies reporting that they've raised wages this year, and only 3% with a decline. And again, you can see that reversal from last year to this year as conditions improve. So as you might expect from those strong sales and profit results, overall results versus expectations were also strong. So this is how they did in 2021 versus their expectations for the year. So 46% of our companies had even better results than they were anticipating, and about 20% saw a decline in results relative to expectations. And again, that's a little bit better than what we saw last year. Some of the issues that were impacting companies this year that impacted their results, either good or bad: talent shortage, we had supply shortages, We had employers or employees that were either working from home or couldn't work at all due to illness or childcare issues. And we also had disruptions in the normal rhythm of business, things like travel. So those were issues that they were dealing with in 2021. Now, we always ask companies that either outperformed or underperformed their expectations to identify the top couple of reasons for that differential in performance, either good or bad. And we'll start with those that outperformed on the left-hand side of the slide. For those companies that performed better than expectations, they reported that they were able to improve internal efficiencies last year. Many of them utilized the PPP loan program. Some of them increased their prices and increased their sales and marketing. And those are the activities that help them drive that higher performance. Now, on the other side, for that percentage that underperformed their expectations, as you might expect, a talent shortage is right at the top of the list. Over half of those companies underperformed because they didn't have the headcount that they needed to drive better results. COVID-19 is at the top of the list as well at 49%, and you could argue that COVID-19 is the root cause of the talent shortage, the higher operating costs, and the supply shortages that were other items that made the top of this list. Now, turning to projections for the upcoming year, despite all the headwinds and challenges that are still out there, companies are really optimistic about the upcoming year. 70% of our survey respondents said that they expect profits or sales in 2022 to exceed the results in 2021. And 2021 was a strong year. So that's a very optimistic outlook. Now, profitability is a little more conservative, and I think you can understand that with some of the pricing pressures and some of the headwinds that are out there, that companies may expect higher sales, but that their profit margins may be a little bit lower. But it's still a very optimistic 62% looking for better results in 2022. And only 4% expect lower sales, and only 8% anticipating lower profits in 2022. Employers are hoping to expand their headcount in 2022, with 65% of our survey respondents anticipating that they will have more employees on board in 2022. Only 4% anticipating a decline. And as you may guess, that's also going to involve paying more and higher wages. So 79% anticipating that wages will rise in 2022, and only 1% looking for a decline in wages next year. As with higher sales and higher profits, the majority of the companies in our survey are expecting that 2022 will be a better year overall than in 2021. 69% of our survey respondents looking for 2022 to be a strong year. Now, what are their strategies for making that come true? Well, a lot of the strategies that we saw focused around the workforce, around increasing the workforce, cross-training the workforce, providing leadership opportunities within their workforce. Those are all the things that we saw turn up in the survey. Diversity and inclusion also showing up as one of the top strategies for 2022. Now, despite the fact that people are overall very optimistic about the upcoming year, there are no shortage of challenges. And these are some of what were identified by our respondents. Finding new talent. We keep seeing it. It's a theme. 55% of our companies, even though they expect they'll do better next year, expect to experience difficulty in adding to their headcount in 2022. COVID-19, and this is before the Omicron news, 43% expect that this is continue to be a headwind for them throughout the next year. Higher inflation. 36% of the companies anticipate that higher inflation will have an impact on them and be a challenge in the upcoming year. And there are a couple of other things that make the top of the list, but those are the top candidates: jobs, inflation, and the uncertainty around COVID-19. We hope that you enjoyed this recap of the First Business Bank Statistic and Trends Report with results from 2021 and projections for 2022. Again, the full written report is available to you on our website at firstbusiness.bank/resources. And while you are there, please check out our other resources for timely and informative content. Thank you for listening.